Okay, so moving away from crime to look at applying prisoner's dilemma to, let's say, a business situation, I want to bring up a duopoly. One duopoly that you may be aware of is Boeing and Airbus. There's only two companies in the world that make large airplanes, Boeing and Airbus. Currently, they each have about half the market, so that means that they're equally matched in terms of market share. And I'm going to go back to 2003. I've been using this since I started teaching years ago, and it's been interesting to watch this play out. So back in 2003, both airlines were considering building what's called a super jumbo. A super jumbo is a plane that would be bigger than the biggest plane at the time, which is a 747. And so one of the things that each company had to consider was, should they make the plane if the other company decided that they also wanted to make the plane? The reason that was an important consideration was because it was believed at the time that the market was big enough for only one company to make the plane. As things turned out, it wasn't even big enough for one company. But be that as it may, just imagine that we've got two decisions. We've got two players, Boeing and Airbus. We've got two decisions. One is to make Super Jumbo or not make Super Jumbo. And let's say that this is the payoff. So if both Boeing and Airbus make a Super Jumbo, they're both going to lose money because the market's not big enough for them. If they both decide not to make a Super Jumbo, they've got other planes that they're making that will maybe, let's say, get them medium profits. It's not, if this plane is going to be successful, it's going to make high profits for the firm that goes all in, let's say. But if neither firm goes all in, they'll still continue to make, let's say, medium-sized profits. So let's say that Boeing doesn't make a super jumbo and Airbus does, then maybe that means that Boeing will make low profits and Airbus will make high profits because this super jumbo is going to be a game changer in the market. I'm not saying that in hindsight it wasn't. I didn't think it would be at the time, but let's say that was the thinking. So this would be the payoff if Boeing doesn't make the super jumbo and Airbus does. If on the other hand, Airbus decided not to make the super jumbo and Boeing decided to go in all in, and this is going to be a really profitable plane, then Airbus would make low profits and Boeing would make high profits. What other things could affect that decision? Well, one could be the number of jumbo jets that each producer already had on the market. So interestingly, Boeing kind of had an advantage there because Boeing already produced a 747, 777. So the 747 and 777 are jumbo jets. At the time, the only jumbo that Airbus had was the A340. So the A380 was probably more important to Airbus than it was to Boeing. So now if Boeing produced a super jumbo, then they'd have the 747, 777, and 7 whatever they're going to call this super jumbo. So if they both made their super jumbos, then there'd be way too many big planes on the market, maybe for the market to handle. If, on the other hand, both airframe manufacturers decided not to make a super jumbo, then you'd have a situation where Boeing would have the advantage because they have two jumbos, and again, Airbus only has one. So it really seemed like it was less important for Boeing to go in this direction and more important for Airbus to do that. All right, so what ultimately wound up happening? Airbus did go forward with producing this A380. That's this big double-decker plane. If you ever seen one of these planes land and all the passengers get off, it's pretty amazing. I mean, it's just a huge plane. In some configurations, I think it can hold as many as 600 passengers. So it would seem like the advantage might go to Airbus. But Boeing decided to come out with another plane called the 787, which is a jumbo that's capable of flying across the Pacific, which is the longest route in the world, and it only flies on two engines. And the reason this is important is because it turns out that airlines and their passengers actually prefer to fly what's called point-to-point instead of the model that would favor the A380, which is a hub and spoke model. So let me just explain how this difference in strategy made all the difference in the world for Boeing. So if you're an airline and you're flying the A380, then what you do is you fly a whole bunch of passengers from different cities into one hub, and then you fly them maybe across the Pacific. So maybe everybody flies into LAX, they get on the big A380, they fly across the Pacific, maybe they land in Narita in Japan, but that's not all these passengers' final destination. So maybe they get on another plane, and some of them fly to Tokyo, from Tokyo over to Beijing, and others maybe go to Bangkok, and maybe others go to Manila or wherever their final destination is. Well, people hate flying that way, and it turns out that airlines know this. Now, the advantage of the 787 is that you can fill up one of those 787s and economically fly people across the Pacific. So you could have maybe one plane going from Mexico City to Tokyo, another one going from LAX to Manila, another one maybe going from Seattle to Beijing. And that's really the way people want to fly. And in the end, what wound up happening, the 787 has been a really hot plane. They can't keep up with all the orders. And Airbus finally announced that I guess the market wasn't even big enough for one company to make the A380, and they're actually finishing their production runs early. They have a bunch of orders that they have to fill, and that's it. And once they fill it, they're not going to make any more. So it turned out that it wasn't a good decision to go in that direction. And so I'm sure that both companies at the time were using some kind of sophisticated way of deciding whether or not they should go into this super jumbo market. But the point is, when you're faced with, big strategic decisions, you've got to employ big strategic thinking. And even if you do, you could still make a mistake. So, all right, let's talk a little bit about cartels and trade associations. So in the United States, cartels are illegal and trade associations are not. So, what is a cartel? A cartel is a group of companies that get together and they collude and try to coordinate their production so that they can maximize profit. In other words, instead of being a bunch of oligopoly companies, let's say, that are competing with each other, they try to act as a monopoly so that they can get higher prices and sell less. So then what about a trade association? What is that? They're a group of companies in an industry that get together, and as long as they don't discuss price and output, that's okay. So, for example, the Beef Council would be an example of a trade association. They get together and they think of ways of getting Americans to eat more beef. That's okay, as long as they don't talk about pricing beef and how many head of cattle to produce. It's okay. They're not doing anything illegal. Or another example could be like the American Medical Association. They're the ones that set the standards for medical schools to graduate doctors. What does doctor have to learn in medical school? They're not theoretically anyway doing anything to set the compensation for doctors. But one criticism of the AMA in this regard is that they are able to restrict the number of seats in medical school. In other words, maybe there's a lot more people that would like to become doctors. And if a lot more people became doctors, then maybe doctors would earn less, and that would bring down the cost of healthcare. Now, the AMA would respond by saying, well, you know what you call the person who finishes last in his class in medical school, right? You call him doctor. And so what they say is, when you're a patient, don't you want your doctor, whoever he is, whether he graduated first or last, to be qualified to work on you? So we're not doing this to restrict the number of seats to make doctors more money. We're restricting the number of seats to make doctors more confident. So these other ones, IATA, Business Software Alliance, they're examples of trade associations which are legal in the United States because they don't get together and try to set output and price. So one way that a cartel works is they get together. Let's say this is a very, very simplified example, and this is not the output levels for individual OPEC countries. But imagine that we've got, and I'm only showing 4 countries here because that's all the screen I have. Imagine that the OPEC members are Kuwait, Iran, Iraq, and Saudi Arabia. What they will do is they will say, okay, well, how much can each country produce? So these are the individual country supply curves. and how much do we want to let onto the world market? In reality, Saudi Arabia is what's called the swing producer in OPEC. They're the ones that that openly adjust their output levels so that they reach a target. So let's say the price is really low, maybe because there's oversupply. Then what we would see is these individual countries would be supplying very small amounts, and Saudi Arabia would be cutting back the amount that they supply. If, on the other hand, they want to get a higher price, and let's say demand for oil is increasing, so you have to imagine demand curves are going to be intersecting each one of these countries' individual supply curves, leading to whatever price it is. But the countries are going to act in tandem. They're going to produce a supply curve for the entire cartel. Once they're done adding that up, then maybe if the price is going too high, and one thing that a cartel has to consider is, well, what is the optimal price for the commodity that we produce? Do we want it to be a high all the time? Well, if it's high all the time, you run the risk of countries looking for an alternative means of, let's say, energy. Maybe more countries in other parts of the world will say, "Wow, the price of oil is too high. Maybe we should switch to something else." So they're not necessarily looking for the highest price, and they certainly don't want the lowest price. But what they will do in order to get to the optimal price is maybe Saudi Arabia will adjust their production so that the price is neither too high nor too low. So this is an article going back a few years. This is when, at the beginning of what was called the fracking revolution in the United States, oil producers were discovering new ways of getting oil from fields that didn't look like they were very good for oil because the oil was trapped in rock. And that had the effect of pushing out the supply curve, what we'll call the long run supply curve, out like this from S1 to S2, which of course would lead to a lower price. Now, OPEC didn't want this, and one of the things that they thought is, well, wait a minute, we have a cost advantage over U.S. producers because we don't have to frack. We've got plenty of oil that is inexpensive to get at. So what they thought that they might do is they might increase the supply even more to drive the price even lower. Now that sounds kind of crazy because if you're dropping the worldwide price by producing more, you're hurting yourself as well. But there was a strategy behind this. They thought that if they could get the price low enough on the world market, that would drive out the frackers because their cost of production was higher. So this is kind of what's been going back since then. You kind of see oil now trading in a range between 30 at the low and say 70 or so at the high, and there's a little bit of movement around this. All right, now cartels, are they successful? Economists believe that they're not, and the reason that economists believe that cartels aren't that successful is because each individual cartel member has an incentive to cheat. So what could happen is, maybe going back to this example, let's say that Iran agrees that it's only going to produce 10 million barrels per day. What it could do is it could maybe produce 12 million barrels a day because it's thinking that it's going to get a higher price. But if they do that, and then Iraq does that, and Saudi Arabia does that, and Kuwait does that, then what winds up happening is too much oil finds its way onto the market. And so instead of getting a high price for everybody, they all wind up with a lower price. So cheating basically should be something that would lead to a cartel dissolving, although cartels like OPEC and De Beers have been around for a long time, so they must have some way of dealing with cheating. But that's the economic theory behind why cartels in the long run should not be successful. All right, let's talk about a thing called a non-collusive oligopoly. We spent a bunch of time talking about firms in oligopoly market structure maybe either getting together and colluding. Well, what would happen if they didn't? This is an old theory. It's not something that is used that much anymore, but it's called the kink demand curve. I wanted to bring this up because you will notice in the graph and short answer questions that you can either choose the monopolistic competition graph or the kink demand curve graph. And the monopolistic competition graph is a pretty extensive, pretty complicated graph to draw. So I'm going to give you the option. of drawing the kink demand curve instead. So what's the idea? What's the theory behind this kink demand curve? There are two demand curves. One is relatively inelastic and the other is relatively elastic, and they intersect, at this kink over here. And you have to imagine that this is where each individual player in this oligopoly market is at. They're at Q naught and P naught. And if the individual firm decides that it wants to raise its price, it moves along demand curve D2 over here, the elastic demand curve, and it will see a drop in total revenue, right? Anytime you are on an elastic demand curve and you raise your price, total revenue will go down. Okay, so imagine again, we're over here at the intersection of D1 and D2. We're here at Q naught and P naught, and now the firm decides that it's going to lower its price. Well, according to the kink demand curve theory, it will now travel down the inelastic demand curve. And remember, anytime you're on an inelastic demand curve and you lower the price, your total revenue will go down. So then why will it travel down the inelastic demand curve? It will do so because its competitors will match the price decrease. In other words, if the firm decided that it's going to lower its price, maybe to get more market share, its competitors are not going to allow them to do that. They'll cut their prices as well. If, on the other hand, the firm decided that it wanted to raise prices, the other competitors are going to say, okay, go ahead, raise your price. We'll stick with a lower price and we'll get more market share. We'll get more business as a result of that. So now, some reasons why the kink demand curve fell out of favor. One is it doesn't explain how they arrived at the kink. It just basically says you have to assume that we start off over here at the kink. That's sort of like a prosecutor saying you have to assume that the suspect is guilty. Just go ahead and start from that point of view. Now you've got to show why. There has to be a reason why we start at the kink, right? Another reason why it fell out of favor is because oligopoly firms were successful in raising prices during inflationary periods like the 1970s. So if this theory was so good, then it didn't really explain how or why these oligopoly firms were able to raise their prices during periods like that. All right, let's talk about a few other pricing strategies. So we've got a thing called price leadership or Stackelberg competition. That's when one firm in the industry sets the price. And the firm that sets the price doesn't necessarily have to be the largest firm in the industry. It might be a company in the industry that moves first, and for whatever reason, every other firm in the industry then follows it. So let's imagine that at the beginning of the model year, Ford is the first mover, and first Ford says we're going to raise the price of our cars by 4% for this new model year. And then maybe a day later, General Motors comes out and they say we're going to raise the price of our cars by 4%. And then imagine the Toyota comes out on the same day and they say we're going to raise the price of our cars by 4%. Is there any collusion here? And the answer is maybe, maybe not. Maybe all the firms in the industry are looking at one firm as being the price leader and then reacting accordingly. There could be collusion. Maybe they're all getting together in a room somewhere, but in the absence of being able to prove collusion, another alternative explanation might be that one firm is acting as a price leader. Does that make sense? Maybe they played this game enough to know that if one firm raises its price, the other firms will go ahead and follow. So an example of, let's say, price leadership and the kink demand curve, this is going back to 2007. In this article, it was talking about how Delta Airlines tried to raise their fares by $5 across the board, each one of their fares. And what happened as a result of that was that its competitors did not follow, right? So going back to the kink demand curve, they raise their price and their competitors say, fine, we're going to keep our prices the same, and they got more business as a result. But then fast forward to another time in 2007, and another $5 increases came from Continental, Delta, and then American matched it. In other words, one airline decided to raise their price by $5 per seat across the board, and all the other airlines said, okay, yeah, why not? We can do that as well. So does that prove collusion? And the answer is no. Maybe one firm is leading and the other firms are following. Maybe they did collude. I don't know, but you can't, just because you get this result doesn't mean that it's proof of collusion. Some other pricing strategies, cost plus pricing. So maybe a firm is dominant enough in the market that what it's trying to do is get a rate of return for its shareholders, and it knows what its cost is, and it's got enough market power so that it prices its product in such a way that they guarantee this high rate of return for investors. Now, I'm not saying that General Motors in its heyday engaged in this, but interestingly, General Motors was able to give a 15% rate of return on after-tax capital for the 4 decades ending in about 1970. And up until about the 1970s, at one point in time, they had a 68% market share, just GM alone, in the United States. So could they have been engaging in some kind of cost plus pricing? Who knows? It's hard to say, but it certainly seems like it resulted in a higher rate of return for their investors. So maybe that's what they were doing. All right, so this ends oligopoly. I'll get these posted real soon, and hopefully they'll be